Thank you, Rachel.
We had a very grim conversation as we confronted, not that grim, because there might be a solution. We confronted what I think is the scariest thing that could possibly happen in the world today to our portfolios. And unfortunately, that thing is exactly what the Fed has told us is what they're going to do. So we know that since 2000, even since 87, every time there's been a problem, the Fed has been coming in and providing liquidity and created this unicorn of a positive carry put in the form of duration, which underlies all of our portfolio assumptions since then. And back in the day, that didn't used to be the case. In the 70s, stocks and bonds were positively correlated to each other, and we see what happens this month when they get positively correlated again, and every hedge fund style is down. So they've been very clear that we're going to have higher interest rates, we're going to have illiquidity. So our working assumption is that the QT world, the world of quantitative tightening, is going to look the opposite of the QE world. So QE, of course, is stocks and bonds up with less volatility. So our simple assumption is, well, what happens if the Fed is successful? We're not supposed to fight the Fed, we've heard that. So stocks and bonds now with higher vol, what does that mean for our portfolios? So we talked first about some of the challenges to portfolios. As we noted before, the average hedge fund return in down months for stocks goes from plus 16% in up months annualized to minus 12 in down months. Now, we can talk about fixed income. It goes from plus 7 in up months for fixed income to plus 2 in down months for fixed income. So already, rising rates is really tough for hedge funds. And it's not just true for the indices, it's true for every hedge fund strategy. You lose about 60% of expected return in rising rate months compared to falling rate months. But then we ask the key question, what happens if stocks and bonds go down together? Well, if we compare up months, we'll call those QE months, where stocks and bonds rise together, hedge funds go from 18% annualized in those months, and down months, minus 14% annualized. So when we talk about a world of low returns, we're not talking about 4% up. We're talking about, in the hedge fund world, minus 14% annualized. We're talking about stocks and bonds down all at the same time. So with that beautifully optimistic question, we started our conversation. And the first thing we talked about was, well, cash seems like a very good thing to do. How fast can you get into cash became a question then. Should you be in cash now? And can you react fast enough to get into cash when you need to and get back out fast enough? For dynamic portfolios, of which we had one that was very active and able to do so, the answer possibly is yes. But for bigger plans, for larger institutions, you really can't do that. So we had another solution, which is to have a downside protective bucket. We already know that puts in general are negative expectation investing. So we then went on to more long volatility strategies, and what we happen to do, surprise, which is in futures to make directional trades which capture realized volatility. The idea was that the common feature of stock and bond declines is realized volatility. We're seeing it this week and last week, and it's a common feature throughout our careers. When stocks and bonds go down, vol goes up. When stocks and bonds go up, vol goes down. And that's the world we lived on until the end of QE. So we had a lot of spirited discussion about that, but we also built some contraptions to symbolize the difficulty of protecting portfolios. And I know that's what you're waiting for. What happened? Well, this time we made it a little harder because it's harder to protect your portfolio when stocks and bonds both go down. So we unfortunately have the remnants of the three devices that were built, and we're happy to show you the movie of what happened here. Let's just say it didn't look very good for these portfolios. There's a lot of egg at the bottom of that bag. Our view, once again, is that it's possible with non-premium buying, long realized volatility strategies. to have a positive carry put on the stock market, to have portfolio insurance that pays you to own it, that has a positive return. And I think the addition to those portfolios may be best demonstrated by our solution to the problem. Once again, we have a little bit of a negative correlation in action here. My colleague Lisa is going to show us what happens here. This is representative of a diversified portfolio that adds a negatively correlated asset with a positive rate of return. Now, you saw what happened when you have no downside protection or ineffective downside protection. You saw earlier what happened when you have some downside protection with negative correlation, and we had a pretty soft landing. Well, this is what we think can happen if you're effectively protecting your portfolio with high return strategies. Thank you.